Okay, I guess the mics are on. Everything sounds good? All right, great, good. Welcome everyone, thanks for coming out. Really appreciate your support. I am Keegan Caldwell. I'm the founder of Caldwell Law. We have an office just down the street on the corner of St. James and German Street. We also have offices in Boston, Massachusetts, and in Santa Monica or in Los Angeles. We started off as an IP boutique, and we've grown from just being an IP boutique. And we realized that we also wanted to be able to service our technology companies that always had funding needs as well. And being in the tech world, we work with funds that have needs as well. And so we've added a corporate practice this last year and are in the process of integrating those practices to provide a service that integrates those two practices to help our clients. We've grown considerably over the last decade, kind of filling out these offices, and our next plans for expansion are in Asia. But no one's here to hear me talk about my firm and all that. What we want to learn about is using IP as collateral for debt funding and possibly for other sorts of transactions. So I'll introduce the person I'm doing the fireside chat with, I guess, today, Mark Fox. Mark and I have known each other for a few years, and I think that we actually came to know each other through another panel that we did. Yeah. And we've worked on a handful of different deals in the debt funding space and have learned quite a bit about that. And today, what we'd like to speak about are some of the things that we've learned to investigate some of the basics for those that are just learning about this space, but also to discuss the things that we've learned over the last few years doing these deals, and and to answer any of your guys' questions that you might have. That's what we'd like to do more than anything, so we'll leave plenty of time for that. Mark, why don't you tell how you've come to found your fund that you're working with now, and a little bit about your background.
Sure. So I'm one of the co-founders of Ghost Tree Partners. Ghost Tree Partners is a private debt lender focused on the lower middle market. And executing deals through a partnership strategy. So what that means is we are providing customized capital solutions to companies. Generally, deal sizes are below 50 million. Most of our deals are actually below 25 million. There's a huge lack of capital supplied to that space, and so that's where we focus. We execute our deals usually in partnership with somebody else. That often looks like another lender, because those lenders that are serving that lower middle market are also underserved by capital. So they tend to have deals that they want to execute, but not enough capital. So we'll partner with those folks. Other times it will look like partnering with somebody like Keegan or an insurance company or another third party that can help us execute opportunities. We have been around since 2021. We do a number of different things. So we do everything from real estate to asset-backed lending to corporate cash flow lending and specialty finance. And essentially what we're looking for is assets or cash flows that we can lend against. And historically, intellectual property would not be included in those types of assets. And I think all but maybe one or two firms historically have not thought about intellectual property as an asset that could be lent against. And that's changing, that's evolving. And I would say it's probably been about 3 or 4 years since that's evolved. And we're incorporating that into how we think about where we can lend and to which companies we can lend. Obviously, if you think about the need for capital and intellectual property, there's a pretty good crossover for the size companies that we focus on. And so that's created an opportunity set for us. We have completed 5 transactions to date that are backed by IP and insurance wrapped, which we can talk about in our discussion. And we continue to evaluate a lot of additional opportunities, both that will include an insurance wrapper and those that will not include an insurance wrapper. And when we can talk about why we deploy those.
Yeah, that's great. And maybe I missed it, but did you discuss, what were you doing before you started this fund?
So I've been in credit my entire career. I started my career at Bain Capital Credit. I'm a reformed distressed and restructuring lender, so I spent more than half my career cleaning up messes, making some of my own, and cleaning those up as well. But I've been a lender my entire career across a number of different industries and asset classes.
Yeah, and I think that the timing of the formation of the Ghost Tree Fund is fortuitous in the timing of the exciting things that have been happening with, especially with regard to the data that we have about intellectual property and patents in particular, and regarding what the value of those that was previously not as readily available. So as Mark has already touched on, the historical context here is that there was really only a couple different PE firms that were providing any sort of IP-backed lending 20 years ago, or 15 years ago maybe even. And they were focused on a narrow area of technology, generally device components like a cell phone, storage, storage and any of the other sort of software, hardware components that are comprise these sorts of devices, right? Like a cell phone, laptop, television, things like this. But that has, in the original entry into that market, I believe happened because there was enough data available for them to make an assessment of the value of that type of IP based on many court decisions and the royalty rates that courts were giving for cases that had damages within that particular field of technology. Now, fast forward over the last 5 years, I'd say, and maybe even the last decade, as the intellectual property field has begun to collect even more and more data in different fields of technology. Now we're able to apply that value of particular areas of industry, the patent value, and to be able to calculate something that makes sense rather than an algorithm that's created by someone in a vacuum. That these are numbers backed by what's actually happening in the market. What is the value of a particular product that's either being sold and the IP that maps to that, or what are the amount of a certain amount of transactions that have taken place within an industry, and what is the average amount of per patent that is being sold within that particular industry. And for most areas of industry, we have that data now, and it's readily available. And so I think that, and again, I'm certainly not a historian on this, but I think that there was insurance companies that began to take an interest 4 years ago.
Yep.
Would you say, Mark?
Yep.
Yeah. And where Aon in particular, who hired several people, a very large intellectual property team, and brought on experts from some of the top technology companies and IP companies that were out there, with the idea that they could value a patent portfolio and be able to provide an insurance wrapper to insure a lender that if someone defaults on paying back that loan, that they will go ahead and cover it because the value of the IP is so great. So they would value the IP and provide a loan at 20 to 50% of value or something like that, right?
Yep.
So this is maybe in the last 4 years that we've seen this happen, and this is not. And the interesting thing here is that then we went from seeing this only happen within the area of device components to happening in all different areas of technology. And I think this is kind of the platform from where we'll have a lot of discussion today, right? So as Mark was already saying, he's worked with a number of these different transactions on the insurance side. And because we want to leave plenty of room for questions, I'd like to whip through some of the basics of what the requirements would be for your experience for the insurance piece, and does that vary for things that are not insured, or have you done deals that are not insured? So we'll touch on that first, but maybe if you can just give us details on what is expected for a company to have if they would like to pursue this insurance piece.
Yeah. Yeah, and I think there's pretty significant crossover between insurance and non-insured. So we can tackle both at the same time, and maybe if anyone's interested, talk about the nuances between uninsured and insured. But essentially, this is still a debt product, right? And so we are looking for some demonstrated track record of being able to generate revenue off of intellectual property. So that means we are steering away from pre-revenue companies and more towards companies that they're not going to be fully established. They're maybe generating $5 million of revenue. We've done deals for less revenue than that. But the critical piece is the intellectual property and the product or the products that are resulting from that intellectual property have been brought out to the market. There's been receptivity to those, and there's been an initial reaction. And we can do our traditional diligence process around market position of those products, around the competitive positioning of those products, a very traditional underwriting based on, granted, limited data, but still data around what the market reaction has been. So certainly post-revenue, not pre-revenue.
I just want to pick at that just for a second, because I know it's something that comes up at least once a week for me. So in general, whether there's insurance involved or not, you want to see revenue.
I would say the insurance market isn't doing any pre-revenue deals anymore.
No pre-revenue deals.
No. Historically, there have been some. There will not be going forward, I can fairly confidently say.
Yeah, and
for
clarity, what does that look like? So you said that you've done maybe some that were under $5 million, but ideally they'd have over $5 million in revenue. Is that?
It's a good benchmark.
General metric.
It's a good benchmark, but it's not a hard and fast rule. There's offsetting factors. So you could have a contract with several customers that is going to generate significant revenue in the future, but you're sitting there at $2 million of revenue today or $1 million of revenue today.
Yeah.
It's really it's looking for receptivity, right? And so revenue is an easy way to measure that, but contracts are also a good way to understand that. Discussions with strategics. There are other ways to get there, but revenue is probably the most basic and easy to understand.
Okay. And why is it that you think that there'll no longer be pre-revenue deals on the insurance side? I mean, I suspect I know the answer to this question, but I think it's important to hear.
So the early data points that we have across the deals that have been done have been not as good for those that are pre-revenue in general, which isn't a shocking statement, I wouldn't think. But also just remember that there's a critical component of what we're talking about today, which is debt versus equity, right? So our upside is capped. We do get some warrants in the company, but effectively our upside's capped and we can lose all of our money on the downside. Equity is a different proposition. And so there is certainly an equity case that makes sense to come in pre-revenue. I think it's harder to make that case for a debt instrument. And that's why you've traditionally seen equity financing early on and then maturing into bringing in debt financing. What we're trying to do is bring in that debt financing earlier, based on IP, versus having to have EBITDA, cash flow positive companies, because at that point a lot of dilution has happened, and it's pretty painful.
Sure.
So that's why we're trying to bring the stage at which we can provide a debt solution in earlier.
Does this mean then that you would look at doing equity kind of balancing like equity and debt maybe in the same simultaneously with a company?
We don't.
Yeah.
We don't because we only focus on debt. But one of the things that can be an offsetting measure of for a company that's smaller is if we see significant equity dollars coming in, if we see significant sponsor support, shareholder support, that's certainly a factor in how we evaluate these companies. Now, I don't want to. There's a whole universe of venture debt, which I think spends a lot of time on that piece of it. So we don't emphasize it that much, but we certainly take into consideration the equity support. And I think it makes sense to pair equity and debt. I think for the size deals that we are doing anyway, I don't think there are a lot of firms out there that are doing both equity and debt on a consistent basis. It's generally segregated.
Okay. When would you say is most common then for, well, maybe before we get to that. So revenue is a very important component of this. Definitely going to have, I think that it's easier for me to put a clear number on things. You said that, like $5 million is a good benchmark, but it could also be that maybe you have $1 million of revenue, but have a trajectory that's includes customers that have already signed up and maybe orders that haven't been fulfilled yet or things like this. You have commitments, but haven't actually seen the revenue yet.
That's right.
But it can be challenging to do those deals absent that.
Correct.
Does that also mean then that you are looking for a company to have an exit before you'd be able to loan? Or is it that you're looking for, because you said that you would do it pretty early. And so for debt, I think lots of times when I think of people giving debt that they want to have an exit on the horizon that can fulfill that debt within the next 3 or 4 years or something like that. Is that also the way that you guys approach that? Or can that take on several different forms as long as there's a path to repaying?
So the expected outcome or the expected exit for us is a refinancing, right? And so what we are trying to do is we're trying to bridge the company from an equity-based pre-revenue market to a cash flow-based lending market, right? So there's lots and lots of folks out there that are going to say, okay, you've got $5 million of EBITDA. Your company's worth somewhere between 8 and 10 times. We can lend 4 times against that $10 million of EBITDA. Until the EBITDA is there, you can't access that capital. So we come in between pre-revenue and when you can go and get a traditional cash flow loan. That's the position that we're filling. Our expectation is, in most cases, we're going to get it taken out by that cash flow loan. More importantly to us is we have to be able to see to a financial profile that can support our debt. So let's say we never get taken out. We just sit there and the company grows to a point where they can service our debt. And one of the things that we emphasize in with our borrowers is, remember, a lot of these folks are coming from an equity mindset.
And because you're agnostic to really how this gets repaid.
Correct.
You just want it to be able to get repaid.
That's
where the equity folks would be more inclined to want to have the company continue to grow, most likely.
That's right.
Yeah.
So, at an extreme example, there are companies out there that may be worth $1 billion that are terrible borrowers versus a company that's going to be worth $150 million, but I can provide $25 million of debt because they're going to cash flow earlier. They're going to be able to support my debt, and they're going to be able to control their own destiny. So when my loan matures, they have lots and lots of different options because they're generating cash flow.
Just pulling on that thread a little bit, just for my own sake and for folks in the room. So with someone that has a very big valuation, like $1 billion valuation or something like that, the reason that they might not be as great as someone to lend to is because their path to revenue is so much farther away.
Their path to cash flow.
Their path to cash flow.
So they're generating revenue, but they're burning a ton of cash.
Well, sometimes they're generating revenue. I certainly represent clients that are pre-revenue that have multi-billion-dollar valuations.
That's correct. That's correct.
That's a different talk.
So it's likelihood of generating cash flow and the amount of cash flow that you're going to generate is important to us versus what your top line is doing. Now, obviously, there's a relationship, but as I said, we aren't sharing in a valuation increase from 100 million to $1 billion.
Okay.
We are very much feeling all of the pain for a company that's $100 million and stays at 100 million and isn't generating cash flow,
Yeah.
and then runs into an issue. We have a default, and we have to deal with monetizing what is there.
The assets that were collateralized or whatever
That's
it was
right.
in the company that you could monetize in some way, shape, or form.
That's right.
Okay.
And assets that are generating cash tend to be worth more in a distressed sale than assets that are not generating cash.
Sure. Thinking about this relationship between equity and debt a little bit more, do you have how are your feelings about a venture funded company that has, quite a bit of equity money put in already into the company? So there's a balance there for you, I guess is what you're saying.
That's right.
You don't want it to be too much, but maybe like a decent sized A round might be an indicator of a positive indicator for you as well. Is that fair to say?
We could spend the next half an hour on this specific topic.
Sure.
But
That's a good one.
it's just because a company's raised $250 million versus a company that's raised $25 million, that doesn't make them a better borrower. And so there is some validity to the idea that if you've spent $250 and you only need another $25 to turn this into, to create significant additional value, well, somebody within that existing investor base who's put $250 in is going to fund that next $25. There is validity to that. There's also situations where if you're in a bad macroeconomic cycle, there's probably issues going on in some of the other portfolio companies, and you have to decide which fires you're going to put out. So there's not always going to be capital available. And then for companies that have raised $250 million, they've also burned $250 million if they're coming to us. And so that burn can continue. So they need more capital to be able to fund this business going forward. And so it's a relative situation, right? If I can provide capital that more quickly bridges to cash flow with a smaller equity base, that's better for me than having this massive equity base.
Okay. Then what is, of the deals that you've done so far that were backed by using IP as collateral, what were some of the commonalities between those companies? Were those all venture-backed companies? Were these companies that were specific areas of technology? Or were there any commonalities at all between these companies?
So we've done healthcare, we've done consumer products, and then we have one tech borrower. But healthcare and tech tend to lend themselves well to IP lending and have traditionally. But there's also, traditional manufacturing that has incorporated IP. Those are great lenders. I think we've just seen less of that to date.
Yep.
The prevalence of intellectual property in healthcare and in tech tends to be higher. So from an industry perspective, that's what we've seen. In terms of commonalities across, as most of the companies that we've lent to have not had venture sponsors. They're mostly either founder led in terms of the capital, or friends and family founder, or maybe a family office. But these are not brand name sponsors or brand
So they
name
may
VC
have done
firms.
some fundraising, just not from
That's right.
professional money.
That's right.
If you will.
Yeah, I think there's still a pretty big learning curve amongst VC firms, amongst sponsors, and this product. And look, this product's pretty expensive, right?
Yeah.
Yeah.
What do we? Maybe that's something to touch on briefly, only because we have a certain amount of time, and I know that there's several questions that we want to get to. So what does this cost?
This will cost somewhere between 15 and 20% all in if you're
with
insured.
with the insurance.
With insured.
Okay.
And then without insurance, you're talking low teens to mid teens.
Okay. And do you think that you would consider things without the insurance?
Sure.
And just based on the strength of the profile of the lender to pay it back.
That's right. That's right.
Okay.
You companies that are a little bit more advanced have a little bit more momentum on the top line, a little closer to cash flow break even, and we'll get to uses of the capital, but certain uses of the capital are more directly tied to revenue generation than other uses of capital.
Okay.
So those are all things that we factor in. They're the exact same metrics that we think about when we're thinking about, are we going to lend to this company or are we not? And then there's just a slightly different filter that you put on of whether you utilize insurance or whether you don't.
Okay.
But it's all the same metrics.
And what is the typical, so we know the amount of revenue, what is the typical amount of patent assets that you'd see to do a deal? What is the minimum amount that you'd want to see?
Yeah, it's been 10 or more. I would say
Yeah.
that's a little bit more dictated by the insurance market than by us.
Okay.
From our perspective, it's quality of the patents versus number.
Yes.
And then you also incorporate trade secrets, right? You might actually prefer a trade secret over a patent. So it's incorporating not just patents, but patents is where you start in the analysis.
Yeah, and on the insurance side, I can speak from my own experience that that's generally, they've said that they want to see at least 20
That's right.
unique families, not 20, not that you filed one patent in one jurisdiction in the UK and then proliferated that filing in several other jurisdictions throughout the world, but that you filed all separate patents within a jurisdiction and then maybe they were proliferated out and could be, so it'd have to be 20 unique patent families rather than one patent that has a bunch of others connected to it. And that's for obvious liability reasons. If you're able to, if one of those was to be invalidated for some reason, then a lot of the value of that whole set of 20 may be deteriorated if they're all connected. Whereas if they're all separate families, if you knock out one and that one's invalidated, you still have the value of all the others that are in the portfolio, right? You talked briefly about the quality of patents. One thing that we've seen over time, even though that we have all of this data, is the way that valuation is approached seems to be different amongst valuation professionals, insurance companies, and maybe even the way that law firms approach looking at the value or funds themselves. Maybe can you speak to the things what makes a good patent valuation for your fund?
We are not experts in evaluating patents and IP. We use third parties to do that. So for us, what we like, what we focus on is mapping the patent to the revenue, right? So if you've got a product that has a unique aspect to it, do you have a patent that ties to that, or do you just have a patent that generally applies to the product but isn't necessarily tied to the unique factor and the competitive edge for that product?
That distinguishes it from others in the
Correct.
market.
And it's actually really interesting to sit down with a management team and have them lay out how they view the patent portfolio to the product.
Yes.
And then actually go and have a professional do that and read the patents and do that mapping, because a lot of the times management teams think that a patent portfolio protects certain things and they actually don't. It's something else. So that's what we focus on, is that mapping piece, and then we leave the more nuanced aspects to the professionals.
Okay. Yeah, one thing that I've noticed is that there were, I bring this up because I've seen tools where there's automation of patent valuation, and I think that at this point, I've not seen a tool that I think gets to a value that could be trusted to dissolve the liability for a lender in a reasonable way, because it's hard to do that exact thing, to map those things. There's several markers like in tools within patent prosecution and in patent law that can be used that could assess the quality of a patent from a patent prosecutor's perspective, whether it meets certain regulatory frameworks, or does it have antecedent basis issues, or obviousness issues, or anticipation issues. Like what issues might it have that we can put it through some sort of tool to identify those. But I think what we're talking about is not those issues in particular, but the issues of the quality being associated with, does this patent connect to the products and the products that are generating revenue for a particular business. And I think that's what's gotten more narrow over the last few years, or what's been honed in on. And that the others, there's a few others that are beginning to work in this space. It seems that more and more folks are headed towards that idea that the product mapping has become one of the more important aspects of valuation. You agree with that?
Yeah, that's right.
Yeah.
I mean, you've touched on it, and maybe we should have talked about it at the top, but this whole, the reason why this ecosystem hasn't existed and why it's priced the way it is today is because you take real estate, the ability to have public comps and to be able to feel confident about a range of valuation around real estate is much higher probability, and there's much more data there than there is with IP. And so really what we're talking about here is a lack of data points and a lack of ability to, with a high degree of confidence, value IP from a lender perspective. And that's why it hasn't been traditionally an asset that lenders have looked to. That will change over time, and I think that's a big part of what we're trying to do. But to your point, on the valuation side, people are also trying to plug in numbers into a quantitative system and have it spit out a value. And I don't think there's enough data to support those values to the point where people are comfortable. And that's why there aren't that many lenders doing this. That's why we're early on. That's why we're charging the rates that we're charging. But we need to build out that data set. We need to build out the outcomes, and we need to understand valuation better.
Which you think is possible?
I do, over time.
Yeah. So you've found more confidence over the years of doing this, but through understanding what's went right and what's went wrong with things.
Yeah, I think where we are today is we are getting better at determining the IP that can be properly commercialized and what's required to commercialize that. I don't think we're at the point yet where we're getting that many data points around, okay, that hasn't worked, now we've got IP, let's go and sell it and see what value. Those, we're still very short on those data points, but we're getting there.
And what can the money be used for? Can it be used for growth capital, for R&D, for litigation? Do you view patent litigation as a bad thing? I guess I'll take those one by one maybe. So can you use the funds for growth capital?
So the answer is yes, and that's why people are coming to us for capital. But there's nuances within that. So I would say the best use of capital is working capital. So I've got an order in hand. I need to go and buy the raw materials, or I've got a mismatch in my payables and my receivables. So I'm having to pay my suppliers before my customers are paying me, so I need capital for that. That's a great use of capital, and those are that capital use means you've got the sales, you've got momentum, you are creating a hard asset. And but it's been difficult to finance for a number of different reasons through maybe a traditional ABL market. I would say similar idea of you've got a factory that's at full utilization and you need to build a second factory. Those types of uses of capital, great. The other end of the spectrum is we need capital for sales and marketing. Now, I don't want anyone to leave here thinking that this capital is not for sales and marketing. But what I'll tell you is trying to determine the efficiency and the return on sales and marketing dollars is much, much harder than some of these other categories. And so, and it takes longer to know whether you're actually successfully deploying those dollars or not. And so, healthcare, for example, it is incredibly difficult to go out and hire a sales team for these small companies. Hire a sales team that can be effective, be able to measure that sales team, and track the capital and the return on the capital for a medical product. Mm-hmm. And so, our experience is, there's got to be there has to be additional factors that get us comfort other than we're going to build a sales force. We've done this before. We're good at it.
We know how to use Google Ads.
And so, right. And so, using existing third-party sales and marketing teams that are already in doctors' offices where you can plug into an existing network, right? Sure. Even though those are expensive, those are established pathways to revenue versus I'm going to build out a sales and marketing team.
So what about R&D then?
R&D is a tough one.
Okay.
There's in between. R&D is tough because
it's where you have to draw the line, I suppose, is the tricky part.
Well, so it's if you're spending R&D to develop the product that's going to generate the revenue, that means you haven't developed the product sufficiently, or likely have not developed the product sufficiently. Or if you have and it's generating revenue and you need additional R&D just for the next generation, but the existing generation can support our debt, that's fine, right? That works. If you have and then the other is R&D on a new product, right? Or a new service. And there, again, as long as you're comfortable that the existing services, products can support the debt, that's okay. Mm-hmm. But you can run into the issue of you basically are, you're pulling capital and value from the existing product and you're kind of starving it to feed this other one. Mm-hmm. And it's very difficult to figure out. Think of it as a pre-revenue asset, right? Which we don't.
Yes.
So you're just funneling money into a pre-revenue asset. It's very difficult for us to get comfortable with that. Mm-hmm. So that R&D is tough.
Okay. So we need to have products already that are generating capital.
Correct. And they may need some additional R&D, but
of course.
But right. they're largely established, or they're so mature that we can feel very comfortable with the economics of that product.
The market's going to continue to grow while you perform the R&D.
And there's sufficient excess cash flow to go and feed some of these other things, the other products.
Okay, and then what about litigation? If a company, I know that in venture capital, traditionally, in my personal experience, it's viewed negatively if someone's litigating patents, whether it's through they're the enforcer or whether it is that they're defending. That can be viewed negatively because they want them to just focus on, continuing to make cash rather than utilizing funds that were provided to them for the purpose of fighting off these lawsuits. It's viewed as a distraction.
Yeah.
However, now we're talking about these assets that have been valued and that I'd imagine in some ways that you'd want to see being used. How do you think that would be perceived if you had someone come to you and was litigating?
If you have ongoing litigation where you're the defendant, it's very difficult to lend to that company. Mm-hmm. So maybe there's some exceptions to that, but I would say that's going to be difficult. If you are the plaintiff, there's IP litigation fund.
Just out of curiosity, Does that apply to all litigations too? Like, you don't really care if it's someone's enforcing a patent against a company. You don't want them embroiled in any sort of litigation at all.
On the defendant side.
On the defense side, right? It's just an issue.
That's correct.
Right, and it's hard to determine what the outcome might be. There's too much there.
That's right.
Mm-hmm. Okay, and so then on the other side, if you're enforcing,
I would say we are early days on a lending product funding that. There's lots of IP litigation financing out there, and there actually it includes insurance wrappers. So you take a portfolio of ongoing IP litigation, and you finance it, and then you put a wrapper around that financing to give you downside protection, and that's similar stage of
It's
maturity.
almost like you can insure anything.
Well,
I'm just joking.
there probably aren't any. Hopefully, there's no insurance companies here that
There
want to
probably
adhere
is,
to that.
I'm sure.
Insurance companies are very discerning and know they won't insure anything.
Okay.
Just want to state that. On the plaintiff side, as a lender, I think it's possible, but very nuanced in terms of what are the, what's happening in the case, because there is reciprocal issues, right? So if you're unsuccessful in your case, what does the defendant do? Do they come after you? Do they come after other patents? Does somebody else come after you? So it does open up. It's not all just upside, right? There's downside, which you can talk about better than I can.
Sure.
So it's very case by case in terms of whether you could get comfortable with that or not. I do think separately from that specific discussion, one of the ways that you monetize an IP portfolio that has failed to commercialize is going to be litigation. And so from that perspective, it would be a very positive optionality to say, okay, this didn't work. Can we go and generate value through litigation?
Sure. And I'd imagine that you would treat it the same as you would other revenue generating assets within a business, where if there was already revenue being generated from IP through enforcement, settlements, licensing, whatever, that could be viewed in a very a positive light, and would suggest that it's already value that's been established, and then probably even more value could be extracted, just like any new product that you're introducing and getting more use out of, more market entry with.
I think licensing and royalties is an underutilized way to monetize IP for companies of this stage, and it's not. I don't mean this to sound like it's management teams being arrogant or not understanding what they're doing, but it always takes longer and always costs more to commercialize your assets.
Yes.
And if you can have somebody help you who's established, if you can plug into an existing network or existing monetization pathway, even though you're not going to capture all of the upside, there are trade-offs. Going the licensing route, going the royalty route, I think is extremely helpful for companies because they can fund themselves with that, right?
And some companies very successfully.
That's right.
Do.
And I mean,
hundreds of millions of dollars worth of that a year.
Your work that you do helping companies that with IP that isn't being utilized by their main product, it's just sitting there. If you can monetize that, that can help fund your main product. It's an underutilized resource often. And
this is a UK specific sort of question. A lot of this work that's been done so far has been, I think, isolated into like U.S. type patents and U.S. jurisdiction. Does that mean that there's not lending happening for European or UK companies? Or I guess answer that question first, and then I'll have a follow-up.
No, we're happy to lend into European jurisdictions. Most of what will happen is they're European companies, but with U.S. They might have European patents, but they've also got U.S. patents.
Okay.
That doesn't have to be the case, but that will tend to be the case for reasons that you know better than I. But there's no, I would say there's no drawback in our view, in our perspective, to lending to a UK company versus a US company. So if they had the same patent portfolio, it doesn't matter that they have to be domiciled in the UK versus the US.
Okay, great. And I do think that there's, I know that there's been more and more attention to doing this here, both in the UK and in Europe. And finding, because the markets do vary, there'll be different factors in doing that. And I think it's at the earliest stages here. But again, where there's a established market in the U.S. and maybe a little bit more in Europe than here in the UK, that there's probably more opportunity to do those things. But that's only that's likely to change and is changing currently right now. So I want to make sure that we leave some time to do some questions. Mona, do we have questions from our online audience? Okay. I have to look at myself.
Now you get to watch
now.
yourself.
I
Yeah.
know.
I don't want to see
It's not
it.
awkward at all. Great. Someone should have told me. Lots of questions here. Would a company that has venture debt be precluded from then doing an IP debt round?
The IP loan would probably take out the venture debt, unless the venture debt wants to subordinate.
They'd want to borrow enough so that you would be the first in line.
Yeah.
Okay.
I mean, if venture debt, if they want to subordinate, they want to go all PIK, and they want to have their maturity be outside of our maturity, then there might be a path, but I don't think they're going to want to do that. So I would think about that debt being taken out. And I would say, back to our earlier conversation, refinancing a debt is not, it would be on the less attractive end of the use of proceeds, because you're not providing fresh capital for the company.
If a company lends, if a company borrows money with IP as collateral, continues to grow their IP portfolio throughout the term of the loan while paying their interest and doing everything else that they should, are they then able to get other valuations and possibly take more debt as long as all other things are headed in the right direction?
Yeah, so this is an important point, because the exercise that we are doing is not solely based on IP valuation, right? So IP valuation, if you think about a real estate appraisal, right? You've got an appraisal and you can apply a discount to that. We are not at that point for IP. So we aren't saying, okay, this IP is worth X, and then 2 years later you've added to that, so it's worth X plus Y. We are looking at this as a going concern enterprise value exercise, and underwriting as an enterprise and as a going concern. And so long as that additional IP increases that enterprise value, that going concern value, sure, that opens up additional borrowing capacity. But just expanding your patent portfolio does not tie directly to your borrowing capacity, because we aren't at the point yet where we can tie a specific value to that next patent or those next two patents, right? Which is what we kind of talked about earlier.
Plus, you're still looking to tie those to the products, and
That's
if
right.
a company is staying the same size with their revenue or EBITDA, but still acquiring patents, then
That's right.
that becomes a harder situation. But if they were growing along with that, then that could be something that might work out.
That's right.
Okay. Does anyone here have any questions? Yes, please.
So it sounds like...
Actually, can you hold on just only because we have the live audience, and then they can hear these questions as well.
So it sounds like, and I think it's the right approach, you're not really looking at the IP valuation. You're saying, is this company a sound company? Can they repay this debt? Oh, they've got some IP. We'll use that as collateral to secure the debt, which I think is the right approach. Is that essentially what you're doing?
Yeah, look, there are some great IP valuation firms out there, but we haven't been able to marry the data with the IP valuations, and so you have characterized it correctly.
Yeah, and so the second question, you were talking about the patent quality. So again, that becomes subsidiary. So for example, I've got clients where we've got a whole load of patents granted, but no one of them is a killer. And actually, what matters is you've got the web that goes onto that product, and if the product died, the IP frankly wouldn't be worth that much anyway.
Yeah.
So you are, if I'm not mischaracterizing, you're lending to a company that happens to have IP instead of real estate or property or other things, and you're taking security on the IP based on what you see as the business valuation. Is that fair?
That is very fair, yes. Now, there are others out there that take a slightly different approach, and they are more IP focused than we are, but you have characterized our approach correctly.
I think it's a sensible approach.
and we would like to incorporate more quantitative valuation data into what we're doing over time. We're just not there yet, which is one of the reasons. That's right.
No, that's the key, I think, is
Well, there are
yeah.
different reasons for why the business failed, right? So you could have a management team that just wasn't capable of. So there are extenuating circumstances, but we certainly focus very much on if this doesn't work, what do we have?
Does anyone else have any questions in the audience here? Mark, please.
What's your due diligence process of working out whether to invest, what the risks are, what the opportunities are? Yeah, I'm interested to know, like, how long does it take?
Sure. Yep. So our process, our diligence process outside of documentation, our diligence process is somewhere between 4 and 6 weeks, and that includes initial call, going through data room, putting together a targeted list of questions and follow-ups, a couple more calls with the management team, in-person visit. Along that way, we'll determine if we need any third-party resources. That could be legal, that could be consulting. In the healthcare space, we almost always hire somebody to help us think through the nuances of the payer system or the technology itself. So bringing on third-party resources, and then we basically put together our thoughts. We have our internal investment committee meeting. There'll be some follow-up from that, and then hopefully that's final questions, final diligence. That's another 2 weeks, and we're done. So that's 4 to 6 weeks for our process, and then documentation is on top of that. Documentation can be, this is outside of the insurance product because that's a whole different process, but then the documentation process is 4 weeks.
And then how does that tend to inform, having done that diligence, how does that inform the deal, that get it over the line or walk away? How do you...
So we'll have, yeah, so it's a good question. I missed a step. So after we have gone through the data room, we've put together our target list, we've had the couple of calls, we'll generally then submit a term sheet to the borrower, and we'll agree to major terms to make sure that we're working towards something that both sides can execute. So at that point, there can be varying degrees of probability of close, but we should be somewhere in the neighborhood of 70% likelihood of getting this closed at that point when we've signed a term sheet.
Right, thanks.
You were talking about that you need more data points for the monetization piece. You think, like, what needs to happen for you to have those, and will that have an impact on the interest rate long term?
Yeah. So the way we think about monetization is going concern. So going back to my distressed days, having enforced on collateral and then monetizing it, we're really using that basis and that again, that going concern model to determine how we think about these businesses, and then supported by the IP. Ideally, we're in a situation where with more data, I mean, people today are saying, okay, each patent is worth about $500,000, right? And if I've got 25 patents, multiply, and we're not doing that. But it'd be great if we could get to the point where we are, or if we can utilize some data-driven resources on litigation, then that can support our underwriting, and that will lead to lower interest rates. But the notion that today, I'll speak for us, the notion that today we can sit there and say, everything else is gone, we now, our collateral, we own a patent portfolio, and we can tell you what we can monetize that for, we can't. And I think that's been one of the issues with the insurance market, and why we're still going through some growing pains, because I think the initial approach was that was possible, and the early data points are that that actually hasn't been possible. Now that doesn't mean it isn't possible, just with the methodology that was put in place, it wasn't possible.
How likely do you think that you will have more data points in the future? When we get to the stage where we can say we have this now in place, or a patent in that sector is on average this, so we can make our life easier in terms of evaluation.
I mean, we're still learning, right? We're active in this space, but that's only been for 3 years, right? And so there may be pieces out there that we haven't come across that can help us, right? There may be resources out there that, and we're spending a lot of time talking to IP valuation firms, talking to legal firms, exploring IP litigation funding to try and put all these pieces together. So I don't know. We're working on it.
And I think that today I would add to that question that, and like was brought up in the question here earlier, you know, you're looking for revenue in companies and then just using the patents as you know, a collateralized asset to do that kind of, you know, in somewhat of an agnostic fashion, right? Where there are some other lenders that are there that have been, I know of a couple that have been doing this for you know, quite a while, but again, they're doing it in, you know, some very specific technology areas that they have, that there's more rich data about, and that they have significantly more data points for in those areas that allows them to at least dissolve some, to be able to more accurately predict what it is that they'll be able to get out on the other side, because they've been doing that already for you know, a decade, monetizing things that may have defaulted in the previous 10 years.
Yeah, it's a good point. We spend a significant amount of time when we're thinking about the downside on the make versus buy decision, right? So is a larger company that's in this space, a larger competitor, are they going to spend the money to develop this product themselves, or are they going to buy this product, right? Buy whatever we have left over after it's failed to commercialize. And patents skew that decision much more to buy versus make. So we are not dismissing IP in any way. We absolutely incorporate it into our thought process. We're not assigning a specific dollar value to it, but it absolutely is important in terms of our comfort level with lending to these companies. And one of the reasons why healthcare is an interesting area for us, and we've done 2 deals in healthcare, is because there's the FDA approval, FDA clearance process, and that skews competitors to the buy versus the make. Why go through 3 years of an FDA process and spend all that money and all that time when I can just buy this and it's already cleared, it's already approved?
Right.
You mentioned that trade secrets might be more favorable to
At
finance.
times, yeah.
And, yeah. Could you explain that just a little bit?
When you hire Keegan to file a patent, everybody can read it, right? And so everybody sees it. Sure, there's a patent there, but some things there are better patents and worse patents. And if you've just basically alerted the market as to what you're doing, that might not be the best way to protect, you know, your know-how.
Yeah.
It could be a trade secret that's better.
Yeah, actually, some of the largest, actually, the largest patent transaction that I've been part of was, I had a client that had several patent filings, but many of them he marked as do not publish, right? So that they would never publish. And the purpose of that was so that when he would go to sell them, if the buyer never wanted those to be in the public view, that they could decide whether or not they wanted to abandon those patents, and they would never be published, right? Where the normal path would be that, you know, even if as long as it went past the certain point of being published, that it would still be in the public domain. This made some other things challenging, like it limited international filings and things like that. But it turned out that when we went to go approach a particular buyer, that it worked out very much in their favor, because they had many different types of manufacturing processes that they did not want the rest of the world to know about. And so those were filed patents, but really treated as trade secrets in this case because they were never issued as patents and they wanted to keep them as trade secrets, right? And I've seen the same thing kind of happen where it's something that people just want to keep. There's things, maybe certain types of technologies where it's hard for the public to extrapolate the way that people are conducting that, right? So, and I think that manufacturing technologies are that way in particular. A lot of the software solutions that we see today, you can give a lot of thought to the way that things must be happening, to an overall system or method of the way that something is happening. But there are, in manufacturing, it can vary very greatly, for instance, and sometimes people want to keep those things as trade secret, you know. But it depends on the business objectives of a company as well. You know. Any other questions?
I had one more just around,
Okay, yeah.
you obviously talked a lot about debt funding and touched a little bit on equity, and obvious reasons we haven't concentrated on that, but how do you see equity versus debt funding for IP evolving? Which side do you think will be more populous with deals in the future?
You know, the construct through which we've talked about it today is, you know, makes IP a good debt product because things have gone wrong and there's value there, ultimately. And for equity, the equity perspective is very different, right? They're not necessarily looking to say, if I invest $50 million, well, a patent portfolio will get me $10 million in the worst case scenario versus 0. Now, they'd rather have 10 than 0, but that's not really what they're playing for, right? They're playing for the upside, and they're going to have some big winners that are going to offset some of their losers. So I don't know if there's as much emphasis or value put on by equity investors for a slightly better bad outcome like there is for a lender.
I would just add to that, though, that there's quite a bit of data that suggests that shows statistically that companies that have patents versus companies that do not have them exit at significantly higher values, like 158% more value than companies that do not have patents, or companies that IPO at a 5 times higher rate that have patents that don't have patents. So there's I'd imagine, I'm not a venture capitalist, but I'd imagine for them that's it's an easy metric of being able to have the value without needing to think about the monetization side of things. Just treating it strictly as an asset that I don't even need to contemplate how it is that I'll monetize those things in the future, just based on the value it will give on an exit potential. Okay, yes. Yep.
It's much maybe easier to monetize patents, but I just wanted to know your views on trademarks and brands generally, because obviously portfolios generally contain both types of IP, maybe even 3 types of IP with designs as well. To what extent are brands and trademarks taken into consideration?
Do you want to take this question, or you want me to take a portion
I think
of
it
it?
sounds like you want to take a portion of it, so I think you should.
I'm just throwing you a lifeline. That's all.
No, it's an excellent question. Why don't you start?
It's a very good question, and I think that a lot of this has started. This sort of IP-backed lending has started with patents in particular, because they were able to begin to extrapolate like a minimum, median, and max value for particular industries. And in some of those cases, the values can be so high for particular areas of technology, right? Arguably, right? But then what's interesting, though, about trademarks is that certainly there are brands that the value of those brands is so significant. But I would also imagine that if you are just growing a brand and just getting started, my guess would be that a company would have to be farther along from a revenue perspective in order for that brand to have the sort of value for a debt lender in particular to find it interesting, if that makes sense. Just because that you wouldn't have as much market penetration or I wouldn't be able to walk out the door and be like, oh, that's a, you know, a Nike sweatshirt or, you know, Lululemon or something like that. Yeah.
Yeah, inherently we're talking about earlier stage companies that haven't established a brand that is particularly valuable. Doesn't mean they won't, but they haven't. I would also say there's a lot of data and a lot of cases of monetizing trademarks. So there was the infamous case of J. Crew dropping their IP into an unrestricted sub that infuriated a lot of lenders. But going back to bankruptcies of all of these consumer-facing Quiznos and and talking about Best Buy and there are a significant number of examples out there of monetizing brands and trademarks, and that's a pretty traditional asset that's incorporated in valuation in the syndicated loan market and in the bond market. It's not applicable here because of just the nascent nature of these brands based on the stage of the company.
But I have seen, though, in my experience, for equity at least, or on an exit, especially on an exit, doing diligence for an exit, that there'll be value, certainly going to be value associated with the trade secrets, the brand itself, copyrights, software, anything that's included with a company in that transaction, they're going to want to assign as much value as possible for, and negotiate that value with whoever the buyer is. So I think it's possible to do it for an equity transaction. I think it's possible to see those things happen for an exit. And I have even seen, I don't know, I know that there are clever ways for brands that get brands that are used like in the movie industry or by well-known like music artists and things like this, that they'll apply for trademarks for those particular things, and then they'll have those valued that are associated with that. And then as that movie becomes less popular, things, they'll depreciate that asset so that they have to pay less taxes or things like this. So that's fairly common, I think. Yeah. Mm-hmm. So it does have value. It's just how is it that you get after it? Yeah. Mm-hmm. Any other questions? I think if you do have any other questions, that we might have you guys ask them upstairs, where we have some drinks and refreshments. That we'd love to have you join us up there. People that joined us online today, thank you so much for logging on and supporting this talk and really helping us figure out what the future of all of this is going to be. It's certainly evolved a little bit over the last 20 years, but the most growth has happened over the last 3 or 4 years. I don't think it's something that's going to go away. I just think that it's something that we're going to get more and more data for and be able to make more empirical based decisions than, boy, I hope this works out, as we have more data points that point to specific values. So anyways, thanks everyone for coming out, and we'll see you upstairs.